Okay, good morning, one and all. I'd like to take this opportunity to welcome every one of you to this morning's event, Creating a User-Defined Index. You got John Hopkins here. Tom Bowley going to be jumping in just a minute. I want to welcome everyone who's new to Earnings Beats. If this is your first time, I appreciate you taking the time to give us a little view. And of course, all of our members, thank you so much for supporting us, including a small group of you have been with us since we first started our company back in 2004. I'm very satisfying to know people have hung with us so long. Thank you so much for your support. So today's event is going to be recorded like every event that we have. For some reason you can't stick around for the entire thing, don't worry about it. You get a copy of the recording and you'll be able to view it as many times as you want. As a matter of fact, we have a pretty extensive library of educational events that are available to our members at Earnings Beats, and that'll include this one as well. So today, basically the way this will work is Tom will make his presentation. If you have any questions, you can let us know. I'm looking at the questions throughout the event. If I can answer it, I will. If not, and time permitting, Tom will answer the questions. You can always send us an email. You just go to our website at the Earnings Beats, and where it says contact us, send us a question you might have, and we'll be happy to answer. Also want to mention, I'm sure Tom will display this at some point. Every time we have a webinar, we have a special where you can save some nice money on the annual membership. It's really the best way to go if you think you're going to be with us a while. We have a lot of events coming up in October, by the way, starting next Saturday. And I think Saturday, and then for the first 3 days of the following week, we have webinars that are going to be highly educational and very timely. And some of our webinars are public, like this one, open to all the Earnings Beats community, and some are for members only. We'll make sure everybody knows exactly what events are coming up so you can choose which ones you want to participate in. Okay, that's all I really want to get into. We want to get into the meat of this thing. Let me see if Tom's around. Good morning, Tom.
Good morning, John. How's it going?
Good. It's always great when you reply. Otherwise, I got to really do some digging quick. I don't know about there, but I'll tell you something. In Charleston today, it's just drop dead gorgeous.
Yeah, it's been pretty nice here. I'm about 3 hours from John. I'm just south of Charlotte, North Carolina, just over the South Carolina line, and it's been pretty nice here. And I think 10-day forecast last time I looked supposed to be really nice. So hopefully everybody listening in's got some nice weather to enjoy here as we move into fall. I'm not a big fall fan. I mean, I like what's going on right now with the weather, but I don't like what's coming.
Yeah, I got it. Yeah, it's been too quiet, to be honest. We've got, something's going to come up.
Yeah.
All right, listen, I'm going to go ahead and step aside and let you take it away.
All right, sounds good. Well, first, why don't we just go ahead and dive right into the agenda so we can kind of let everybody know what we're going to be talking about. Obviously, the introduction, welcome everybody. User-defined indexes, and some of these webinars, by the way, can go on for quite a while. I don't think this one will be that long today. I'm hoping that we can be done. Haven't really talked much about user-defined indexes, so I don't know what branches I'll head out on, but I'm thinking within an hour, hopefully we'll be done. If for any reason you have to leave, all of our webinars are recorded. And if you're not currently an Earnings Beats member, anyone who came in today, we will have you set up in our Earnings Beats Digest newsletter. It's completely free, no credit card. You can unsubscribe at any time. But it's just a way for us to keep in touch with our community, because after this event, the recording we will send out to everyone. in our community, including that free newsletter community. So it's just a way for us to be able to get everything out to those who can't make it or can't stick around. So if I do end up going longer than an hour or whatever, and you can't, you've got other commitments or whatever, don't worry. We got this covered. We got a recording, and we'll make sure we get it out to everyone. So we're going to go through the user-defined indexes. This is something that I've been with StockCharts now for, gosh, I don't even know anymore, maybe 15, 16, 17 years. And I've been writing in the Chart Watchers newsletter since 2006. I really wasn't that familiar with user-defined indexes until we began tracking our portfolios back in the fourth quarter of 2018 when we started our model portfolio. And it's actually a really cool feature, and I could see where it would be of use to a lot of folks. So we'll talk a little bit about what they are and then the basics of creating those user-defined indexes. And then for me, it's always about following the charts. And in the case of setting up UDIs, user-defined indexes, and if I'm using that acronym throughout the webinar, UDI, that is the user-defined index. But UDIs, you can create charts off of the UDIs. So once you establish the data and have it loaded into StockCharts will produce a chart for you. And that's pretty cool. I mean, when you think about the different things that you can use these UDIs for, and I'll go over some of that just a bit. And then I'll just wrap up with my final thoughts about a little bit about the market, a little bit about these UDIs and the way we use them and so forth. So that's what we're looking to do today. So let me go ahead and jump in here. I was trying to find something first. So hold on one second. Okay, there we go. All right. So before I get into this, I do want to just make everyone aware that we do have a webinar special. I want to make sure that that is up on the screen. Is that up on the screen for you, John?
It's up on the screen.
Okay. I just want to make sure because I'm actually using a different computer today for this because I have everything on my on Excel on a separate computer, not usually the computer that I do my shows from. So I just want to make sure that everything's coming across. I realize maybe the print might be a little smaller. Maybe I can even adjust this a little bit. Hopefully that helps just a bit. And hopefully it's in focus. Everybody can read it pretty well. But like John mentioned, we always like to have these webinar specials. For anybody taking the time to come in and join us, a little reward there. But also, we have our regular annual fee at Earnings Beats that offers significant savings even without a special. And so we just want to make sure over and over again that our members and that any guests that we have are aware of what we offer. So normally you take out a 30-day trial with Earnings Beats. At the end of that trial, if you don't tell us you want to become an annual member, we just automatically drop you into the monthly. And the monthly is at $97 a month. Well, 12 months of that would be $1,164. With these webinar specials, we always give a 13-month deal for the price of 12. So one additional bonus month would have cost you another $97. So 13 months at a regular monthly rate would cost you $1,261. But we have a special going on. This webinar special will last through October 5th, and you can get in for $697, which is 44% savings off of what normally would be that $1,261. Question that always comes up, well, what if I'm on trial? Do I lose the rest of my 30-day trial? No, you will not. You'll get the rest of your trial, and then you will get 13 months on top of that. So if you're still 20 days away from your trial expiring and you want to take us up on this offer, you can do so at the end of the next 20 days when your trial expires. We'll tack on 13 months. So you won't lose any time. But you can, go through here. It's at the top. When you go to earningsbeats.com, it's at the top of the website under webinar special. So you can come back and check this out. But I always like to point it out, just make sure that everyone is aware of our special. Love to have you take us up on it. All right, so let's move on into the UDIs. And the first thing I wanted to do today is just, if you go into StockCharts and you hit the search, you can just type in user-defined indexes and it'll bring up this page. And I think it's, fairly self-explanatory about what these user-defined indexes are. When you think about a stock like Apple, all that data is stored at StockCharts. They have a contract with a data provider that sends them all the information for Apple, by the second, every trade. And so all of that is in the StockCharts system. So when you pull up Apple, StockCharts already has all the information and it just reflects it in a chart. With user-defined indexes, you are creating the data. StockCharts isn't getting it from anywhere. You're creating it. So you have to tell StockCharts what the data is. And that's what you end up doing with a user-defined index. You can create the data in any manner you want. And this part right here, I think, is pretty interesting. You might not even think about some of the things that you could be charting, but this lays it out. So if there's a stock price for a stock and StockCharts, for whatever reason, doesn't follow it, it would have to be a pretty crazy stock, I would think, because I've never had a stock that StockCharts didn't cover. But if there was one, they didn't cover it, you'd have to enter the data. Stock prices that have been edited by you. So if you're looking at Apple and for whatever reason, you want to adjust the data for some reason that StockCharts doesn't know about, you're going to have to input that. StockCharts isn't going to know. Portfolio value over time. And this is the key one for us because we use the user-defined indexes to track our portfolios. So every quarter, we announce the 10 equal-weighted stocks in each of our 4 portfolios that we're going to hold for 90 days. Well, StockCharts doesn't know what our 10 stocks are, and StockCharts doesn't know the equal weighting and how that's all, being constructed. So we constructed at Earnings Beats on an Excel spreadsheet, and I'll show you. I'm going to go through that and show you how we do it. And then we take the value of the portfolio every day, and we enter that value into StockCharts. Now, we only give closing data because user-defined indexes cannot, it can't take on the I think it's intraday. I don't think they'll give you like an hourly chart or something like that. I think it's got to be, you can provide a high and a low for the day. So you could do a candlestick chart or a bar chart or whatever you want. But for us, it's a lot of work to try and figure out what the high and the low was for 10 equal weighted stocks during the day. I mean, it doesn't even matter. It's just what the value is at the end of the day. So that's what we enter. So portfolio value over time is really important. I mean, you could monitor your 401k. Just, go to if you've got multiple accounts, you just go into a spreadsheet or you just tally up the total and you could put your portfolio value in and just every day track that. You can chart it. Net worth. I hadn't even thought about that, but if you're really, you keep track of your finances really closely and, you've got all your debt, all your assets, maybe you have a program that you run, you could literally just put in the value of your net worth daily, weekly, monthly, whatever, time frame works for you. A custom technical indicator calculated by a third-party program. So if you're using something outside of StockCharts and you want to be able to follow this particular technical indicator, you enter it in. And this, I think, pretty much just sums it up. The price of anything you can think of over time. Then you have your weight. You want to track progress on, trying to lose weight or something. You put your weight and have a chart of your weight. So anything you can think of that you want to be able to track over a period of time, you can use the user-defined index to identify those values or to track those values for you. So I think it's a pretty cool thing. Now, I'm not going to read through this entire article, but it goes through and it tells you essentially what you need to do in order to create and modify these user-defined indexes. Now, if you're somebody who doesn't really like to follow along and try and figure it out on yourself, but you want somebody to kind of show you, Julius DeKempenaar, who's a good friend of mine, and he's the creator of the RRG charts, which are all over StockCharts. He wrote an article back in April, and he pointed it out to me this week when I had written about user-defined indexes. And so I went back and looked at it, and this would be a great starting point. This is an article of Julius's in his RRG charts blog dated April 15th, 2020. So if you want to go, you could just pull up his blog and then just scroll back. Or there's one neat feature here where if you pull up somebody's blog, you can hit the blog archives. So it's April 20th. So you just go back to 2020, go to April, and scroll down to the 20th, or actually 15th, I'm sorry, April 15th. And then there's his article. And I mean, he goes in and shows you exactly, how to create, how to post, some data, and then to download a data set, very specific instructions. So you might find this article to be really helpful if you want to create a user-defined index. But really, I mean, seriously, just walks you through every single step to create a user-defined index. So check that out. All right, following the charts. Now, well, actually, let's not go to following the charts. Let's go more into the basics of creating the UDIs. So we talked about it. This is kind of the definition, but I want to go through the basics. So the first thing I'm going to want to do here is I want to bring up my Excel spreadsheet. So bear with me for a second while I do that. And I'm going to bring up the model portfolio, aggressive portfolio, and so forth. So let me see if I can get that for you. All right. So it's not letting me make it bigger, but I should be able to do it here.
Yep, nice and big.
There, that should be even better.
Yes, that's better.
Okay, so back on November 19th, 2018, we had been, if you're not familiar with Earnings Beats, we have what I consider our flagship chart list, the Strong Earnings Chart List. And probably since 2014, 2013 maybe, I've been trading almost exclusively off of that chart list. I'm not going to say every trade is coming, from a stock that's on that chart list, but just about everyone is. And some of it gets back to my background as a CPA. I mean, I had to, trust management teams and so forth, or go in and corroborate why I should trust management teams when I used to audit companies. And so I think it's a big thing on Wall Street. I think that, they're putting together estimates of future guidance, and they're putting these into their models, and then they're using, current interest rates, discounting back future growth and everything to come up with what they believe are fair valuations. Well, a lot of the numbers are known, but the one estimate is what management is telling you, what the company is telling you that they believe they're going to be able to do going forward when they provide their guidance. And companies that don't provide their guidance, Wall Street has to make up their own based on just what they know about the industry, what they know about the competition, and so forth, and what they believe based on economic growth. I mean, they've got a bunch of, economics, geniuses at their disposal that are constantly looking at the economy and spending patterns and everything else. And they're putting all this together to come up with a valuation on a company. And, every company's got different price targets because every company's making different assumptions. Every Wall Street firm, I should say, not company. And I think probably the biggest problem with public companies is when they have a management team that either doesn't have a strong handle on their company's basic environment and so forth. I mean, Wall Street's relying on these management teams to give them some really good numbers that they can rely on. And if anything, Wall Street wants companies to under-promise and over-deliver. That's been the key theme of Apple over the years. I mean, Apple rarely misses. Apple, not only is it a great company, but they tend to be very conservative with their numbers. And so Wall Street loves Apple because Apple always seems to come in and beat estimates and make these Wall Street firms look like geniuses. But then there's the other side of the spectrum where you have companies that want to be, I call them wannabes. They want to be really big, and they tend to live in a dream world sometimes, and they provide these estimates that they can't live up to. So they overpromise and underdeliver. And I don't believe Wall Street firms like companies like that. They don't like management teams that are giving them numbers that later they have problems meeting. Because how do you value a company that's telling you that your future is going to be X, but they can't meet the current numbers? How can I believe what you're telling me next year is going to be in the year after when you can't even beat or match what you're telling me you're going to do this year or this quarter? And so a lot of that is built into the strong earnings chart list. The strong earnings chart list only has companies that beat Wall Street estimates as to both revenues and earnings per share in their latest quarter. I'm only looking back one quarter. I don't go back and say, well, who beat the last 4 quarters or who beat the last 2 quarters or 8 quarters? I just want to see them beat the last quarter. That's the initial filter for the strong earnings chart list. And then, are they liquid? I don't want a company, yeah, they had a great quarter and they look great, but they only trade 3,000 shares a day. Well, if it's a $5 stock trading 3,000 shares a day, $15,000 controls the market. You don't want to get into stocks where, stocks can be completely manipulated when it doesn't take much capital to drive the price up or down. And usually those illiquid stocks tend to carry pretty wide bid asks as well. So you're paying extra. You get in at the ask, and then when you want to sell at the bid, then you've got a loss right from the get-go. So the whole idea is to stay away from illiquid stocks. So companies beat their revenues, beat their earnings per share in their latest quarter. They're liquid, and then I pull up the charts. And if they're a relative leader in their field, or maybe versus the S&P 500, or if their chart's just in a nice uptrend, bullish pattern, any of those things, then they go on to the strong earnings chart list. This is a revolving list. We are continually updating it. As companies come up for their next earnings report, they get deleted off the list. Then they report, and if they beat and they meet the filter requirements, they go right back on the strong earnings chart list. Well, over the years, this chart list has had anywhere from a couple hundred, maybe 150 charts to all the way up to 500, which is the max allowed at StockCharts. And so we were getting a lot of questions from members saying, well, this is a great concept. We love it, but there's 300 charts right now. How do I, can you narrow it down? Can you give me the best, 5 or 10? Well, that's when this started. That's when the model portfolio began. And I thought, okay, well, if I'm going to give my top picks, let's start tracking it. You got a lot of services out there that'll say, hey, we're the greatest thing since sliced bread. Look at all these great picks we've had. But they don't tell you everything, or they don't track any of their suggestions. So this is a way for us to track, and it gets back to that user-defined index. But StockCharts doesn't know which 10 stocks we picked. So this was the first 10 stocks that we picked in the model portfolio going back to November 19th of 2018. And this was the price of each of those stocks that day coming across. Now, what I did over here, actually, let me go ahead and set this. We'll freeze the panes. There we go. All right, so now you can still see the date over here. So what I did is I just created this fictitious $100,000 portfolio, $10,000 into each stock to start, equal weighted. And then I took the price of each stock, dividing it into the $10,000 to figure out how many shares you'd have to buy. Now, granted, this is fractional, and you just can't go out and buy fractional shares anywhere. So that part of it, I guess, is maybe just a little bit off. But for purposes of tracking and equal weighting, we needed to use fractional shares. So that's the number of shares for each of the stocks. And then we just keep it the same. You're going to hold that many shares. The only thing you have to adjust is if there's a split. So recently, Apple split, Tesla split. So we had to go in and adjust this, because otherwise, if you leave the number of shares the same and you cut the price of the stock, in 1/5, like we did on Tesla, that would have a major impact on this calculation if you don't adjust the number of shares. You have a 5-for-1 split, you get 5 times as many shares. So you'd have to adjust that. And that's what we did. I think if we go down here, and look. And I'll get to this later, but here's Tesla. And this was August 19th. This was the last quarter. Tesla's in our model portfolio right now. 12.1 shares, but when they had a 5-for-1 split, you have to multiply that times 5, and that comes up to 60.48. And then when you come over here, let's see, that's line 483. So when you come over to Tesla, see how the price went down by 80% divided by 5? That's why you have to multiply the number of shares by 5. So it has to be split adjusted. You have to be careful there. Otherwise, you'll get a crazy valuation. But getting back all the way to the top, let's go back to the beginning. So you can see all of the shares remain the same throughout the period, and then the prices get adjusted. And I'm entering this into an Excel spreadsheet, not into StockCharts. I'm doing this into an Excel spreadsheet. And then once I calculate the value, because every day the value of each stock varies from that initial $10,000 level based on whether the price is going up or down. And as that goes up and down, the total value goes up and down. Now, what I did here for the UDI value, and this is what I input into StockCharts, what I did here is I just simply took the 100,000 value and divided it by 1,000 just to make the number smaller so it's easier to input into the user-defined index. There's also ways that you can just upload the data. Just my own personal preference, I like to input it just because visually in my head I can kind of watch and see what the numbers are. I'm kind of a, maybe a little bit of a lunatic when it comes to math and numbers. I have, I'm not going to say a photogenic memory, but I have a pretty good memory when it comes to numbers and how things have been evolved over time. And so I like the exercise of entering this into StockCharts, and I'll show you how you do that in just a couple minutes. But that value then is simply going up and down. So in the fourth quarter of 2018, if you remember, we had the trade war. And December was a brutal month until we got close to Christmas. I think it might have been December 26th we bottomed or something. But anyhow, if you look at where we were when we started December, the value of this portfolio had gone from 100 to 112.50. So we were up 12.5% in 2 weeks, feeling pretty good about the portfolio. And then the next 3 weeks hit, and you can see from 112.50 all the way down to a low on December 24th of 89.87. So we were then down more than 10% from that 100 level to start. That's more than 10% to get down to 89.87. And that was in just a little over 1 month. Wasn't quite feeling so good about things at that point. But that bottomed, and as the market came back, you can see the values moved back up again. So this UDI value here of 100 is my initial value that I would use to create my new user-defined index. Okay, so that's how this spreadsheet gets put together. Now, after 90 days, just so you can see what we do with our model portfolio, after 90 days, we come back out on February 19th. So we did November 19th of 2018. Then we do February 19th of 2019. Then we do May. That would have been the close. We're doing it as of the 19th. So it would have to be based on the close on the 17th. And then that also starts, that first change would be on the 20th. So that's May of 19. Then we go to August. So you can see every 3 months we're changing things up. And we have to go back and then completely redistribute the portfolio value. So at the end of that first quarter, 100,000 had gone to 125,000. And so our value is this divided by 1,000. You can see that up here in this formula. So I'm just taking the total and dividing it by 1,000. Now, I go into the next quarter. I've got 125,669. I don't have 100,000 anymore. So the 125 then gets split equally by the 10 new stocks, which are CMG, T-Mobile, Informatica. I'm not sure if I got that one right. 1-800 Flowers, TransDigm, Cisco, Xilinx, Fluidigm and Zebra Technologies, mine as well. So all of those are then set up as the new stocks for the portfolio. And there are the shares, taking the 12,566, dividing it by the price of each of the stocks. There's your number of shares you'd have to buy. And then they're treated the same all the way through the end again. And we calculate the value at the end of that quarter. Our 125,000 had gone to 130,000. Now we got 13,000 in each stock, and on and on and on. So this is just a running list of our model portfolio stocks, and where we are right now. This is our 8th quarter, and where we are right now is, as you can see, these are our stocks that we currently have. So we promised that we would divulge. I mean, we're about halfway through this quarter at this point. The stocks have been amazing. I mean, we started this quarter with a value of 227,000. Remember, we started with 100,000 back on November 19th, 2018. And now we're at 254,000. We've had a huge quarter so far. That's the value of the quarter, 11.79%. I can tell you the S&P 500 is red right now for the quarter. It's red. And our model portfolio is up almost 12%. That's a lot of outperformance. So anyhow, we're up to 254. As of Thursday, we're at 258 and change. I mean, Friday was not a very good day for our portfolios because growth stocks, the NASDAQ, was treated much more rudely than the S&P 500. But still, we did outperform the NASDAQ. I think the NASDAQ lost like 2.7 or 2.8%. And we were down less than 2%. So we still did better than NASDAQ, but underperformed the S&P. But these numbers, this 11.79%, this is the return this quarter through Friday's close, through yesterday's close. It's already been updated. And if you ever go into our website, if you're not a member, and you go into our website, let me move this now. And go back over here. So if you go into earnings beats and you go to the home page, you will see our portfolio is at 154%. I was just talking about. There it is since inception. S&P up 24% since inception. There's that 11% number I was just telling you for this quarter. And there's the S&P 500 down more than 0.75% this quarter. So overall, I mean, I think our portfolios, when you look at since inception on all of them, you can see right there, model portfolio is killing the S&P 500. Aggressive portfolio also not too far from tripling the S&P 500. Strong AD portfolio, which we started in May of this year because of a technical phenomenon that started back in March, and I'll show you that in just a minute. But there you can see the strong AD portfolio more than doubling the S&P 500. The only one that we have right now that's trailing a little bit is the income portfolio, and honestly, it's because of one quarter. It was the quarter that the pandemic started because we were at all-time high going into it, and I thought, okay, we're going to be a little bit more defensive. And I put a financial stock in there. I put a real estate stock in there, which I don't even like real estate, but I wanted to have a little bit more defense. It was a really high yielding real estate company. I think it was yielding like 6-7%. And that's one of the things we look for in the income portfolio. And I thought, well, we'll just play a little bit more defensive, maybe look for a little bit more dividend yield. Well, when the pandemic hit and the market got hit hard, you would think that those aggressive growth stocks would have been the ones to take the big hit, but they weren't. It was actually defensive groups that got hit the hardest. Real estate was clobbered. Financials were clobbered. And so our our income portfolio last quarter, not this quarter, we're actually outperforming the S&P, but last quarter, the income portfolio underperformed by like 10 or 12 percentage points. And that's why we're trailing. That's the only reason why we're trailing. Anyway, so those are the numbers. So you can always come into our website, again, if you're not a member, and check this out and just see how we're doing. I think we've been doing very well. I think the numbers speak for themselves. And it really just relates back to our philosophy and our strategy of wanting to invest in leading stocks and leading industry groups. And you might say, well, what happens when we have a bear market, and you're in these stocks? Well, if we have a major shift in the market, we're probably going to underperform for a quarter, at least one quarter, maybe two, until the charts start lining up to tell us to get into some other areas. When you get into a bear market, a typical bear market, this was not a bear, this was a cyclical bear market back with the pandemic. And I wrote about that back in March. This was not a secular bear market. This was not Great Depression 2.0. This was a blip. And when I say a blip, and I'm not talking about from a healthcare perspective, it's much more than a blip there. But from a financial perspective, in a couple of years, we're going to look back at this and it's going to look like a blip on the chart, just like the 1987 market crash did, in my opinion. I think we're in a secular bull market. I think we're going a lot higher. And I think this is a blip. 2020 is going to be a blip on the chart when you look back in a few years. Anyhow, so let's maybe talk a little bit about this model portfolio chart. All right, so now we're going to move into following the charts. So you kind of got a sense of the data and all, and I can go over here, go to my dashboard. And in order to create the charts, you've got to be in your user-defined indexes. And I've had members say, well, why don't you just send me the chart on the model portfolio and send me these charts? I can't send you the charts. All I can send you is a picture of the chart, because all the data that goes into this it's in my account at StockCharts. StockCharts doesn't have this data except in my account because I've input it. So I can't send you the chart. I can't send you the user-defined index for you to have in your account because StockCharts doesn't do that. But I can show you, and I'll get into the chart in just a minute. But here is where I enter the data, and I can view all data. So if you go back to the very beginning, oh wait, that's the aggressive. I was like, why didn't it go all the way back? Let me pull up the model, which in here I have listed as top 10. Because that, when we first started, it wasn't really model portfolio. It was the top 10 picks or top 10 stocks because we didn't have other portfolios at the time. But let's go ahead and look at the view all data. We can go all the way back. I mean, this is the data that has to be input. So all the way back on November 19th, there's the 100 I was showing you on the Excel spreadsheet. Here's the 97 on the first day. And remember, December 3rd, we topped at 112. And remember the 24th, we went down to a low of 89. There's the data. So I'm going in here physically every day and typing in and adding this data. Okay. Now, once you've done that, you can pull up this view chart. And when it comes up, it's showing, I don't know if this will help or not. Let me. Just going to try and make this chart a little bit bigger on the screen. And then I want to change because the candlestick, remember, candlesticks are great when you have a high, a low, open, and a close. But all we have are closes. So really the only thing we need is a solid line chart. And then instead of the RSI and volume, doesn't matter. I didn't input any volume for anything. And then instead of the RSI, what I'm going to do is a price performance chart of the S&P 500. This is how I basically communicate to our members every weekend when I do the EB weekly portfolio report. I have a chart that looks pretty similar to this. And so since the beginning of time, you can see model portfolio was going up. And actually, this isn't, that was just last year. Let me go back. And I can select the start date as 2018, 11, all right, 11/20. And so now you can see I started at 100, went down to 99 or whatever it was, back up. You can see there, that was the 112. back down to 89. And so this is tracking all that information that I input. I have a sharp chart, just like you get on Apple or just like you get on the S&P 500, because now StockCharts recognizes the index that I created here. Now, when you look at it, you might look and say, well, you know, you're just doing what the market's doing. I mean, you're going up, market's going up, you're going down when the market goes down, you're going up when the market goes up. You know, you're just basically doing the same thing the market's doing. Well, we started at 100 and now we're at 250. So I wouldn't say that we're doing what the market is doing. I would say that, you know, at this point we're up 150%. And if you look at the, let me see if I can make this just a little bit bigger there. If you look at this, 25% return, 24.44 on the S&P. My value is now 254, which means I started at 100. So I'm up 154% versus 24%. Now, another way you can do this is because I already have in my account, if you type in your account at top 10 picks, it'll say no data provided, because in your account, StockCharts doesn't recognize this. It recognizes it in my account because I've entered all the data. All right. So another thing that I can do is now I'm going to go over to my portfolio charts, and I actually have a new chart that I put in here today just for this, just so you can see. This is where I have a price relative chart. I have top 10 picks versus the S&P 500. So now this is showing me, am I outperforming the S&P 500? Am I underperforming? Am I just going along for the ride? And what I wanted to show you is that back at the end of 2018 into early 2019, I was outperforming very substantially. Then for next year, a lot of choppiness, you know, back and forth. When the pandemic hit, though, look at where we were on the model portfolio when we hit the pandemic. And I know the market's been bad, but the market's broken back out to an all-time high. The S&P 500 hit an all-time high, and we have crushed it. We've absolutely knocked it out of the park. And it all started back in March. And the reason it started back in March was because we realized at the very beginning, when I posted back on March 13th, and I could probably, I don't know if we go into, I think it was in Chart Watchers. I want to say it was March 13th. So let me see if I wrote an article that day here. All right. So here, all right. So what I said was I'm firmly in the camp of this being a cyclical bear market rather than a secular bear market. And the difference is cyclical bear markets tend to be, you know, cyclical bear markets within secular bull markets tend to be devastating, but very short term in duration. So you can go back and you can look at this article. But I went through and I started talking about some of the things that I was seeing in the overall market. And I had more charts after the middle of March where I began to notice that the AD lines on many stocks were getting hammered to the downside. And I'm going to show you what I'm talking about. I'll just give you a couple of examples. So you look at a stock like AAL, which is an airline. So you've got American Airlines. And let me pull up the accumulation distribution at the top, or I'll do it instead of the RSI. So accumulation distribution. I'm going to make this chart bigger so that you can see it a lot better. Okay, now I want you to look at AAL as it made the move down in February and then throughout March. And I want you to see the AD line going down right with it? And then it just kept going down further and further and further. That to me was confirmation that there was a lot of distribution taking place in American Airlines, a lot of sellers in the airlines. And if you look at these candlesticks, if you're a candlestick fan, notice almost every single one of them are filled, meaning that you're closing beneath the open. All right, almost every single one of these, you were closing below the open. And so when you're finishing weak and you've got volume increasing, that sends your AD line reeling to the downside. But then there were other companies like, let me see. Well, I'll show you. Let me go over here. Actually, let me go over here. Let's do, I'm going to show you our strong AD portfolio. I mentioned in an article that I would show this to everybody. So I'm going to show you our charts. Let's view all. So you can see the stocks that we have in this portfolio. They're all different, by the way, than the model portfolio. So we're outperforming the S&P 500 with different groups of stocks, which is really impressive, because the more stocks you take into account, the more and more you're going to start looking like the S&P 500. So it's not easy to take different portfolios of 10 different stocks in each one and outperform a benchmark like the S&P 500. If you've ever done that or tried to do that, good luck. I would not even thought that we'd been able to do it, but the AD line certainly has helped us, and this has been one of the things that we've looked at. So here are the 10 stocks. So we got Peloton, Chipotle, Square, Regeneron Pharmaceuticals. They got a big lift, by the way, on Friday after the close, because it was news came out that President Trump was going to use one of their antibody. Trying to think of the right word. Let me check. Medicine, whatever. It's a shot that he takes. But this has not been approved yet by the FDA, which is kind of strange, to be honest. But I think the way the market is reacting is that, President Trump, they do designate these things before FDA approval. They do designate that some people can use these for emergency use. Now, I don't know what all that entails, but anyway, I would think from a common sense perspective that President Trump and his medical advisors probably had a choice of different companies and which ones to take. And it came out that he had taken Regeneron's antibody treatment. And so the stock, when I looked last time, it was just briefly, but I think the stock was up maybe $20 or something after hours on Friday. So we'll see what happens on Monday. Now, I think that could go either way. If President Trump's health deteriorates, then some people will probably begin to insinuate that this antibody treatment doesn't work. But if Monday morning he's feeling a lot better, you might see a huge pop on Regeneron. So this one could literally go either way. But anyway, Regeneron's in the strong AD portfolio. Genmark, Lululemon, Facebook, Fastly, Neo, which is an auto company, and then Wayfair. Now, when you look at most of the sectors and industry groups, these are leading groups for the most part. They're not all top performing industries. Most of them are, but the stocks within them are all leaders. And so I'm going to go ahead and show you these charts. I want to make sure the AD line comes up on this. It does. Okay. So here's Fastly. Now, Fastly, when you look back, look at the huge drop in price back in March. And during this period, the AD line was starting to go up. Price was way below anything else in the last, previous 4 or 5 months. AD line never went down. And in fact, as it was going down, it was setting new highs here. And look at the AD line just continuing. So what that tells me, remember the airline I was showing you had all those filled candles and basically closing near the lows? Well, we had some filled candles, but we also had some big volume days where we closed darn near the open. And look at these huge hollow candles on the way back up. So those are all signs. And as volume picks up over here, we're closing much more at the high end rather than the low end. And that's what sends the AD line up. Now, I don't want to spend too much time because I want to go through all these real quick. But you go into Square. Now, Square went tumbling. But once again, the low here never took out these prior lows. And then when the stock started moving, so did its AD line. Wayfair. Look at Wayfair. Big move down. This low held this previous low. And the stock went from 110 down into the 20s. Low 20s. And still, the AD line didn't go below that prior. And then as it came roaring back, look at the AD line just rolling to the upside. Peloton. Big selling. Peloton in early March was setting a new high on its AD. And again, a lot of it is because we don't see those huge, big filled candles. Almost every one of these has a long tail to the downside, or we closed somewhat close to the middle of the midway point, and that's how the AD is calculated. If you close above the midway point, that's a multiplier that you use times the volume. If you close all the way to the top, you'll get 100% of your volume added. If you close right in the middle of that day's candle, you get 0. And if you close at the bottom of that day's candle, then you take 100% of that volume and subtract it. And that's how you would go lower here. But as you look throughout the year, look at this. I mean, we had huge, this was earnings day, by the way. We had one huge day down on AD because we had massive volume and we closed on the low. So that took a big toll. But look at it come right back up as we break out. So Peloton remains very strong. NEO. I mean, again, back in March, you go lower. We never take out that prior low. And now look at it as we move higher. I think it's been accumulated throughout the period. Lululemon, big move down. What's the AD line doing? Barely even see a budge to the downside. Chipotle, big move down. AD line breaking out. Look at hollow candles in here. You know, I wrote about this a lot in March and especially in April. That's when I really started seeing that I believed anyway that the market was being heavily manipulated at the opening bell. We had all the media reporting these horrible things, Great Depression 2.0, Dow Jones, futures down 1,700 one day, 1,100 the next. People were panicking out, thinking there's the end of the world. And yet, during the trading day, we saw many companies doing what CMG was doing. So yeah, everybody was stock went down, everybody was panicking, volume was heavy, but we had a lot of buyers, and that's what was sending the AD line higher. Look at CMG now. I mean, it's been a huge winner. We were down low 400s back in March. We went up to almost 1,400 beginning of September in Chipotle. Institutional investors were they were buying anybody's shares. Anybody that wanted to sell, they were buying. So you had the media screaming on the one hand that the market's going to zero basically. And then you had institutions that were just sitting by buying everybody's shares. And we saw it in the AD lines. Facebook, big sell-off, $220 all the way down to 130 something. AD line was breaking to new highs. Look at all these hollow candles. That doesn't look like the airline chart I showed you. So, and I wrote many articles back then, but one I remember writing was, we have a bear market and a bull market going on simultaneously. You just have to know which ones fit into which categories. Facebook was being accumulated in March. American Airlines was being distributed heavily. I mean, Warren Buffett infamously came out and said they sold every airline share that they held. And when we got a little bit of a bounce in airlines, everyone was saying, I made a mistake. Airlines have continued to underperform. He knew what was going on, and he got out of every share. Mr. Value, I'm going to unlock the value over time. Got out of every share of airlines. That ought to tell you something. Genmark. You can see Genmark. Hold on one second. Genmark really didn't go down much in March. It went down in February, went sideways in March, and initially the AD line was weak there. But look at what has happened since then. It's been, and even recently with the sell-off, and that was due to Abbott Labs. They actually got hit just like QDEL did, QDEL. They got hit at the same time when Abbott Labs came out with their $5 15-minute test, coronavirus test. This is a diagnostic company that has their own tests. And so a lot of these other medical diagnostic companies got hit hard. But while it was getting hit hard, the AD line was going up. And now it's starting to rise back. I tell you, if this stock gets back up through 15, QDEL's already made a huge recovery. I think Genmark, if it gets through 15, is probably going to follow suit. I mean, we've got the 50-day, we got gap resistance. But if we get through that level, and the accumulation distribution at least is saying we probably are going to, Genmark looks interesting. And then, of course, Regeneron is the one I was talking about. But look at this. I keep looking at Regeneron saying, it's underperforming. It's pulled back a little bit versus the biotechs, but the AD line is stubbornly staying right up near the high, even though the stock has now been trending lower for over 2 months. I think probably something good's going on in this company, and maybe because of what President Trump did on Friday, maybe that starts to unlock some of the value here. We'll see. But anyway, those are the 10 stocks. And the main reason why we started the Strong AD portfolio, that was back on May 19th when we started it, was because of this relative strength here in the model portfolio. We went back and we looked and we found that, hey, that AD line is powerful. And so we began putting together a portfolio simply based on the AD line. Now, one thing we do when we put these portfolios together, it's not what most people would traditionally say is diversified. Because if you're really going to diversify, you're going to get, a technology stock, a discretionary stock, an industrial, an energy stock, a financial, a real estate company. But I believe that's a huge mistake. I've never been a fan of diversification, not like that. Because to me, what you're doing is just saying, okay, half my money, I just want to lose some so that I can make money on this other half. I don't know what the thinking is there personally for me. I know markets rotate, but if you're adjusting your portfolio every 90 days, just stick with what's winning for now. And when energy starts winning, we'll get in. Energy's been underperforming the S&P 500 for 9 years. So if you've been rebalancing your portfolio every quarter or every 6 months or every year, you're taking money out of your winners and putting it in a rat hole and just letting it just continue to deteriorate. It's not my style. I want to go with the winners. I want to go with the leaders. I want to go with those strong earnings companies in the strong earnings chart list. And that's where we get the majority of our portfolio stocks. I would say all of our portfolio stocks, but when we created the strong AD chart list, we made exceptions. Because if we've got companies that are being heavily accumulated, but maybe matched their earnings estimates or maybe didn't even beat their earnings estimates in the last quarter, but Wall Street is still accumulating it, to us, that's something that's really important that we want to be aware of. All right. So the other thing I did is this is the model portfolio relative to the S&P 500, but I also did the same thing with this strong AD. And so you can see this is the relative performance of the strong AD versus the S&P 500. And look at what's just happened in September. The market is not near its high right now. We've pulled back quite a bit. The strong AD on a relative basis is at a new high. And if we pull up the strong AD just on its absolute chart right here, right now we're up 32.35% through Friday's close. The S&P is up 14.56% during the same period. And on an absolute basis, you can see here, see how the S&P is way below that high at the beginning of September? Strong AD just broke out. That's the benefit of following these companies that have strong AD lines. All right, so that is basically following the chart. So, my final thoughts are this. If you want to track, and I'm going to show you one more thing. Unfortunately, for whatever reason, it's really upsetting me. I've got another user-defined index set up. And I'm going to go in here and I'm going to show it to you. And this one is just called my pandemic list. And I don't know why. I'm trying to pull up a chart. I think it would be really useful to view a chart. And it's telling me that it's unable to find data. If I could have found somebody at StockCharts this morning, when I tried to pull it up, it didn't work. And I couldn't get anyone at StockCharts. But I've put the data in. All the data is in just like it's in all these others. I went back to February 19th. And let me just explain a little bit about what this user-defined index is. I went back to February 19th, started this fund with $100 or 100-point value, just like I did all the other user-defined indexes that I've done. And I tracked an equal-weighted portfolio using 10 indexes instead of 10 stocks. And the 10 indexes I used, I don't have them right in front of me, but I know I used airlines, I used hotels, I used mortgage REITs, I used recreational services. I used aerospace. Essentially, all of the groups that were showing that heavy distribution back at the, from February 19th to say, early April, all the worst performing industry groups that, in my opinion, were the most heavily impacted by the virus, I set up an equal weighted user-defined index tracking those 10. And just to show you how good it's working, we start off with a value of 100 back on February 19th, and a lot of things have broken out to new highs. I mean, NASDAQ's way ahead of where it was on February 19th. The S&P broke out above its February 19th high. The Dow hasn't yet, but it's gotten close. Look at this index. We were at 100 back on February 19th, and I'd love to be able to have you visualize this on a chart. We're still sitting at 62. So the article that I just wrote, and I'll pull that up for you, just wrote it this morning. You might want to go in and check this out. How can we tell when the pandemic-stricken groups begin to lead? I think eventually they're going to, only because they're so beaten down. We're going to get to the point where they're going to be able to start growing their earnings. When we get past this virus, or when the market, we don't have to get past the virus, when the market begins to anticipate that we're getting past the virus, or that we're going to get past the virus, money will begin to rotate into these panic-stricken areas, or pandemic-stricken areas that we saw and that we've been seeing ever since that February 19th top. These are groups that are taking the longest to recover. At some point, because I believe the stock market's going higher, I believe we've got a great bull market, secular bull market ahead for the next 10 years. Some people probably think I'm nuts, and that's fine. I do all my research independently. I try not to listen to others. And I believe we're going to go a lot higher. But the bigger question for me is, what is going to outperform? Because I want to outperform the S&P 500. If all of a sudden many of these stocks that have been leading with these strong ADs, if they start to falter, and give way to give way leadership to some of the other areas of the market, I want to be able to see that. I want to know it before somebody comes on in a year on CNBC and tells me, oh, 6 months ago, airlines started to perform well. Well, that's nice, except you can't really invest 6 months ago. And so I'd like to do my own independent research. And that's what I do for our members at Earnings Beats. I want to make sure that we're dealing with the best information based on the charts, not based on what's being presented on CNBC. And I got a little bit of a funny story. And I get this all the time. I'm not, pointing fingers at any member, but I did get a question from a member, and I won't, certainly wouldn't give away any names or anything, but I had a member email me this week and said, I can't even remember the name, but he provided me a link and said, this person thinks we're going to have a crash. What do you think? And gave me the link. And I don't usually, honestly, I don't care what anyone else says. I mean, I have a lot of respect for a lot of the folks at StockCharts, and I'm always reading John Murphy's information because that's really one of my mentors throughout the years. A lot of the inspiration that I've gotten in the market to research and really try to figure out what's going on, a lot of that inspiration comes from John Murphy. Reading his books, I would highly recommend his books. Just the way he looks at the market, I think he was a pioneer in technical analysis. I think he still is one of the best technicians out there. We certainly have our differences, I guess, in strategy. I'm more short-term. John's more big picture. But I have learned so much from John over the years, and I have so much respect for his ability and how he looks at the market. So I continue to do that. But outside of that, and of course, Arthur Hill and Greg Schnell and Julius and Aaron and all the folks at StockCharts that I've worked with over the years, I've gained a great deal of respect for the work that they do. But when I hear somebody, saying the market's going to crash, it's literally an eye roll for me, because we just had a crash. The market doesn't just keep crashing. We have We have a few crashes in our history. I'm not aware of any multiple crashes that we have. And so when somebody's predicting a crash, first of all, the market's already very nervous. So that's priced in. We've got a VIX still at 27. That's still historically very high. And that tells us that the market's priced with a lot of nervousness in it. I don't see another crash. I mean, anything's possible. And then I started reading a little bit further. And one of the author's arguments was that last week he had one of his worst days trading. He lost more money than he should have based on how the overall market did. And whenever that's happened in the past, there's been a crash. And I almost wanted to just stop reading there. It's like, okay, so you lost money in your account, you're calling a crash. Like that's going to be the best predictor in the market. Yeah, I'm not really seeing that reasoning. And then he went on to point out that valuations are sky high, in his opinion. Of course, he didn't say why they're sky high, but in his opinion, they are sky high. And that's my problem, is it? And, you know, sometimes and as I read down, I saw that, you know, he's been featured on CNBC and so forth. And I'm just thinking, yep, that fits right in perfectly with the view I have of CNBC. Somebody just coming in, winging it, no backup, not really providing you any coherent research and strategy, and yet getting airtime. And, yeah, call it a rant, I guess. I just get really tired of, I read through the article and I just was shaking my head the whole time. I'm certainly not going to change the way I view the market based on that article. And, you know, Dave Keller at StockCharts, another great technician. I would highly recommend you tune into him at 4 o'clock Eastern every, well, it might be later in the day now because of the pandemic. I think they're working outside the office. And maybe it's 6 o'clock Eastern, but whenever Dave comes on, you probably should check that out. At the end of the day, he gives you a recap. But one of the things Dave talks about is the biases that we develop. And, you know, if you're bearish and you go out and you read an article of somebody who's bearish, your bias will automatically tell you this person is credible because they think the way I think. So they're right. I'm going to follow them. And if you're bullish and you read an article of somebody's bearish, your bias is, well, this person doesn't know what they're talking about. Well, the truth is probably somewhere in the middle. But you've got to have the ability to independently review things and not follow the masses. I mean, one thing we do at Earnings Beats, I hope and I think better than anybody else, is educate. There's a lot of services just say buy this, buy that. And we've got some of that. I mean, we in our daily market report, I point out stocks on our various chart lists that you can, you know, that I like. And, you know, certainly it's up to each individual member whether they want to buy it. That's completely up to them. I'm not a registered investment advisor. Earnings Beats is not a registered investment advisor. We do not offer advice, period. What we offer is education. These portfolios, I'm not telling you to buy anything in these portfolios. I'm telling you that leading stocks and leading industry groups are a great way to approach the stock market. And here's our educational strategy that is in real time. We've got recorded webinars talking about these stocks. We've got the spreadsheets to back everything up. And we've got the results that I think prove what we're trying to teach. And I hope that that comes across much differently than other services. I really want us to be known as an educational / research firm as opposed to a trading company or a trading firm. Even though I am a trader, I love to trade. But, you know, I look back at what John did writing his books and passing along all that information. And I've been asked, you know, why don't you write a book? Well, first of all, it takes a long time to write a book. And that's the one thing I don't have a lot of on a regular basis is time. I stay pretty busy. So I don't have time to sit down and write a book. Maybe somewhere down the road, maybe I'll think about it. But right now, I just like to educate through our service at Earnings Beats. So I apologize for not being able to get you the chart of this pandemic. That is really a bummer. But what I will say, last thing, and then we'll wrap this up. That the high right there, and I was going back through since I couldn't pull the chart up, and I was looking for previous highs. And I mean, here you can see a high of 62.17. Here was a high of 64.51, 65.12. And I thought, oh, okay, we just need to clear 65. Well, then I went all the way back to June, because June 8th was kind of a big deal. That's when a lot of the stocks that were hit really hard by the pandemic, they were leading the market up until June 8th, and then they fell apart. And I want you to look at the high that was established on June 8th. 72.29 was the high established. We're not there yet. That was the high in June. Now we're at 62. We're still 10 percentage points below. The market is not pouring in. I know we just had a really good day on Friday. The Dow outperformed. The S&P 500 outperformed. Value stocks were crushing growth stocks. It was one day. The rest of the week was the opposite. So, short term, we go through these periods where money rotates. Would I be shocked if value leads over growth for the next week or two? I wouldn't be shocked. I do think that focus is going to turn back to growth stocks when these earnings reports start coming out, because I think there are companies like Zoom and Peloton, and I think these companies are being accumulated for a big reason. I think these numbers, when they come out, I think Zoom just reported, so they got a little ways to wait, maybe Peloton as well. But those types of companies, and there are plenty of others. I mean, Wayfair, just so many of these companies that have, the pandemic fell into their lap. All three of these companies I just mentioned, Zoom, Peloton, Wayfair. It's not that they weren't good companies before the pandemic, but man, you talk about companies that were just sitting in the catbird seat when this pandemic hit. Zoom, any company that wants to, work from home, wants their employees to work from home and still be able to collaborate online, my gosh, Zoom's perfect. How about the people couldn't go to the gym? All the gyms had to close down around the country, but still wanted to exercise. Those people have Peloton to thank. And Peloton has the pandemic to thank, because all of a sudden people weren't going to stop exercising. But now it's a paradigm shift. People are actually working, or exercising at home. And I know people who have the Peloton equipment who absolutely love it and are not going to go back to the gym. Some will, but a lot won't. And so, again, it kind of fell in their lap. And then think about Wayfair. I don't even shop, and I bought off of Wayfair. And I can't tell you how many emails I get with them and how many specials they have. And I click and I go in and look, and every once in a while I pick something up. I'm just one person, doesn't even shop. Imagine the people that like to shop. This company has just gone gangbusters, and Wayfair had a lot of short interest, as did both Peloton and Zoom, by the way. So this wasn't just the pandemic falling in their laps. It was also a rush to the exits for all the shorts that had been betting against these companies. So it's been a little combo. But I still like those companies, and I think they'll continue to do extremely well here, at least for the near term. And I say near term, I'm thinking next few months. I don't try to get too far out. And I let the market tell me, what looks good, what doesn't. So I'm going to continue to follow this pandemic UDI, and I'll report it on it once in a while. I'll certainly be reporting on it quite a bit to our members. And so if you're not a member, I would certainly encourage you to become one. We do have a free, it's a fully refundable $7 30-day trial. So if you like what you heard here today, and you just want to check us out, you're not going to hurt my feelings if you don't like our service. We've had plenty of people who've tried it, and they say, it's great. Either, I can't afford it at the time, or it's just not my style. That's fine. Again, no harm. But if you don't try it, you're not going to know. And we have a lot of very happy members. Most of our members, probably I'm going to say 85% of our members are annual members, because they do take us up on that deal to cut the cost. If you commit to us, we commit to you. That's kind of the way I look at it. But if you go to our homepage and click on this Join Today button, you can go through and fill out the form. You'll get a 30-day trial. You'll get charged $7, and then we'll refund you the $7 within a week. So literally it's a no cost trial, net no cost. And then after 30 days, you can decide what you want to do. But I think, and by the way, I'll mention this too. Those portfolios were stock portfolios. We're about to start October 19th of this month. We're going to be announcing a model ETF portfolio. So if ETFs are your thing, that's the other thing. Sometimes we have people come in and says, well, I really like what you do and I love your strategy, but I don't trade stocks. I trade ETFs. Well, we're going to have an ETF chart list that's available to be downloaded by our members. And we'll also have the strong ETF portfolio. I'm still a fan of stocks. I think I think you're going to do better with doing a portfolio of stocks than you are ETFs. And I'll explain why more in a different webinar later this month. But I know we have a lot of folks who I think would benefit from that as well. And the whole theme there, the educational slant to our ETF service is going to be know what you own. Don't just buy something because you think it's diversified and it's been doing well for 3 months. I mean, understand exactly what you own in terms of what areas of the market is investing in. What are its top holdings? What do those top holdings look like? If 50% of an ETF is in 10 stocks, I think it'd be helpful to know if those 10 stocks are healthy stocks. Kind of just makes sense to me. But anyhow, I'd love to have you join us. And any of you out there right now that are trial members or are monthly members, go back. I mean, take us up on this webinar special. Save yourself some money. Commit to us. I think you're going to enjoy our service for the next year, actually 13 months because we'll throw in a bonus. But $697 over 13 months, that's not much more than $50 a month. And I think if you compare that to just about any service out there for what we offer, I believe it's the greatest value in the market. So that's all I had. John, I don't know if there are questions.
A comment and then a couple questions. One comment from Dan said, you can add a field on your Excel that calculates the high and or the low of a column.
The problem is for our model portfolios, in order to calculate a high, at 10 o'clock in the morning, 4 of the stocks might be at their highs, 6 of them might not be. And then at 2 o'clock in the afternoon, the 4 that were at a high might be lower and the others. I don't think we can just take highs of every stock in the portfolio and then lows of every stock because they're not all occurring at the same time.
Okay.
And honestly, I don't even know what the purpose would be. I don't even know that it matters. It's a buy and hold. So we're not trading intraday.
Right.
So I don't know if the intraday numbers even matter as far as I'm concerned.
All right. Here's a question. Can there be negative numbers in your index?
I've never tried it. I don't think so. I don't know what StockCharts would do if I put a number in. Well, let's try it. I'm going to try it. All right. Oh, I can't pull the chart up on this one. So let me, let's go. I'll go into this model portfolio. Okay. So all of a sudden, for whatever reason, the market collapses because that guy had a bad day in his own personal account. So that means we're going to have a crash. And I don't even know, maybe because you leverage, you could actually lose more than what you put in. But let's just say this falls to minus 1.0 on October 3rd, which is today. Let's save. All right, it's there. Now let me see what the chart looks like. Oh, there you go. It was a bad day.
I see it. Yeah. It's probably a pharmaceutical.
Yep. What else?
On the UDI, I don't know if you know, on the UDI, what is available to an extra member?
Well, you need to check with StockCharts. I know at one point, or I think at one point, as an extra member, you get 1 UDI. Maybe I'm wrong. You probably, maybe you could go in here and search. I don't know. Service levels, data plans, and pricing. Let's try this first. User-defined indexes. Well, it just has a check mark. Yeah, it doesn't tell me. Yeah, it just doesn't say how many. For some reason,
Somebody's
uh-huh.
making a comment that you really need a pro subs subscription because as an extra, it's only one UDI index. Is it worth the upgrade?
Yeah. Well, I mean, I use the Pro, and right here kind of lays out. I mean, you can come back to this when I just typed into the search box service levels, and I was able to find this. You might want to come in and just take a look and see what they offer and whether or not it makes sense to you. I mean, like maximum chart width, does that matter to you? Auto refresh, if you use their auto refresh, 15 seconds versus 5 seconds. Chart lists. I know Greg Schnell, I mean, it's unbelievable how many chart lists he has on there. But I bet I'm sure he has the Pro service, and he probably couldn't use the extra because he probably has more than 250. So if you're somebody who has a ton of chart lists, then it makes sense. Custom technical scans. I mean, I have a few different accounts with StockCharts for different reasons, but I don't have anywhere near. I mean, I'd be fine with an extra, but I wouldn't want the basic because I need custom technical scans. I want, technical alerts I don't use. And the main reason is because I'm watching the market all the time. But if I was somebody working, I am working, but if I was somebody working a day job and couldn't follow the stock market, then I might want to set up alerts. So if I have a stock goes below a certain level, they send you an email or they text you or whatever. And so that might be important to have more than 10. You might need more than that. So just come in here and compare the services to see what makes sense.
Well, Chris is saying extra members can create one user-defined index. Pro members can create up to 30 different user-defined indexes and can give each index its own unique ticker symbol.
Yeah. Well, I mean, we have multiple, so I would have to have the Pro for what I'm doing with the UDIs. So if you think that there's reason why you would need more than one UDI and you think it would be useful, is it worth an extra $15 a month to you? I mean, that's your decision.
Yeah. Hey, let's see what this says. Maybe you can make sense out of this. How to run a quote unquote high quality company screen on an established chart list or a strong future earnings and strong earnings screen on an established chart list.
I don't know if that's coming from a member or a non-member, but I'll just point out, let me go ahead and go in here to our service. I mean, we have scanning strategies for our members. And so I'm hearing, how could you come up with a good scan, it sounds like, of companies on our chart lists? Mm-hmm. These are the ones that we provide for our members. So there's a high volume scan. Literally, you just take the syntax here. And the purpose for this particular scan is if you wanted to find stocks on our chart list, say the strong earnings chart list, that maybe has traded more than 40% of its normal daily volume in the first half hour. That's something to me that could be significant. So this is a test or a scan that I would run at 10 a.m. using this number. Now, if I wanted to run the scan at 12 o'clock instead of 10 o'clock, I might want to up that percentage. I might want to say, okay, give me all the ones as of noon that have traded at least 75% of their, 0.75, or maybe even 1.0. Which stocks have traded their normal daily volume in the first 2.5 hours. That would be if you want to capture high volume stocks. And then you can pull the charts up. You already know the volume's very heavy. See if anything technically is happening on the chart. Then we have downtrend reversal scan. This is one of my favorites because when the market is weak, a lot of times our good stocks go down with the market, and I want to know when they start to reverse. And this scan right here is perfect because I don't know why it keeps doing that. All right. So if you just copy, so if I just take that, hit the copy button, and then I go over to, and I'm going to do it just so you can see. Copy. Let me go down to the scans on the dashboard. New scan. So I already copied from our website. Now I go into new scan. I don't need anything. I've already got everything I need in that syntax. All I do is hit paste, and there it is. Do it as of the last market close, and I'm going to just do this for those of you that aren't members. Just because all of our chart lists that we do, our members can download into their account. If they're StockCharts extra members or above, all of our research, all of our work, my strong earnings chart list, you can download all of our work right into your account. So I'm going to run this scan, and essentially what this scan is it'll return any company that for the last 5 days printed a lower high than the prior day. So for 5 days in a row, it kept printing lower highs. And then today, it printed a higher high. So it's a reversal off of a downtrend. And I don't know if there were any because we've been mostly in an uptrend. So I don't know. But let me just put it in here. We'll see. So I added that. And there it is. Check my syntax. And then run scan. 1 SNCR. So of the 470 charts or however many we have on that chart list right now, 1 meets this criteria. Now I can look at it right now and look, and the Scooter score is 15.9, which kind of tells me it's probably not been doing very well, but let's just look at the chart and see. All right, so I pull up the chart. Well, it made a big reversal off of a key support level. I mean, we've been going down to this $293 level multiple times, and we did reverse off of that. So maybe we're going to go get a 20-day test. But overall, I'm not overly impressed with this stock because it has been in a downtrend. It's not following the NASDAQ, and it's not following many of our really strong stocks to new highs. But I don't know if that's the question that was asked. But, yeah, I mean, we do have the various scans on our website that you literally, it's already pre-done for you. And we have a purpose. So we're kind of explaining why we would use this scan and for what reasons and against which chart lists and so forth. Anything else?
No, but I just want to bring up Monday should be interesting. Now this, things can change every minute, but Trump's doctor, made an update and said that his conditions improved, and speaking specifically that Trump received the Regeneron's remdesivir. That I can't wait to see what happens. I'll tell you one thing: if things improve and he's back at it sooner than later, and they come up with a stimulus package, this could be something. In terms of the market, and this Regeneron could be rewarded.
Well, I mean, that would be the first of its kind where,
yep.
Obviously still you don't have
it's
the
so
FDA.
High profile too, though.
Yeah, I mean, everybody's going to know about it. That's for sure. I'm glad we have it in our portfolio right now. But if he takes a turn for the worse tomorrow, I'm going to be wishing it wasn't in there. So,
yeah, that's true.
Some things you can't. I mean, I can't control that. I can't control whether Regeneron's deal works out or their
right.
treatment works. What I can do though is look at the chart, and when the chart tells me that Regeneron's been one of the best bios, and it's been heavily accumulated, and it remains strong on the AD line, I think it's giving us technical signals that are very bullish, and that's what I'm going to stick with. I feel better about that, looking at that chart, than I do about anybody talking on CNBC. I could care less. I mean, people may not realize it, and well, our members probably realize it, but I never have CNBC on. I never watch CNBC. About the only thing I do news-wise, I like to get news. I don't want people commentating, give me their opinion, because it just clouds my own view, and I like to come up with my own independent analysis of the market. But as far as looking at the charts and so forth, it's all built in. Like I said earlier, Wall Street has their experts. They have their PhDs, their MBAs. They're all working for them, and they're going out there meeting with company management. They have advantages we don't have. Now with commissions down to zero and all, we also, it's much more competitive. It's much more equal landscape. But if you get in the habit of researching, and with intermarket work and all, like I said, I give credit to John Murphy, but there are so many things you can see about the market that you just can't see by looking at the S&P 500. You've got to be able to have a little bit more, and this is my background. I'd love to analyze. I don't care what it is. And, my daughter who works for me, who's out on maternity leave right now, but she's a CPA as well. And she started working with us about 1.5 years ago. And John, as well as, how detail oriented and how she analyzes. I mean, the apple didn't fall far from the tree.
No, 2 CPAs on the team.
Yeah. I mean, we love to analyze, and I'm trying to teach her what I can about the market. And she picks this stuff up so quickly, and she's so bright.
Yeah.
But that's what we do. I mean, we look at the market different. I can't tell you what the market's going to do in 2021, but I can tell you when something piques my interest, I will research it until I'm blue in the face, trying to figure out if we can gain an advantage somewhere. And I think that's how, we've done so well in 2020. I think we picked up on a lot of stuff very early on that especially that this was not going to be something that was going to last a long time, that the market was going to bounce back.
Yeah. And, the other thing too, we're going to wrap up here, folks. Thank you, for being here. But one of the things I pointed out in my article this weekend, Chart Watchers, was when looking at the performance, of our 2 leading portfolios, because we get a lot of questions. I even got a couple of questions during this event that I answered about, what do you do with the stocks during the 90 days? And the whole idea is to hold on to them. And a great example, I think you mentioned Chipotle before, which sunk dramatically and only to move higher during the portfolio period. Another great example is Quidel, QDEL, which is a pharmaceutical on the in one of our portfolios. That stock, when it was part of the model portfolio, was at 241 on August 19th when it closed. Stock dipped to 174. It looked like it was doomed. You know where it is now?
It went to 137.
Yeah, 137. Right, 137. That was the low, right? 137. I'm looking at that closing price, but right, 137. And just the other day, it got right back to the entry point. So the one thing about the model portfolios, you can have a couple of stocks that sink, but if you have a couple of stocks that really take off and others that sort of do okay, you can have a couple of bombs, in the portfolio. So it's really offsets. Some of the great winners offset the losers, and some of the losers are offset by some of the really great performers. And that seems to have been the case since we started that portfolio 2 years ago.
Yeah, the idea here is with our portfolios, for anybody who's new, is, we want to be transparent. And we want these portfolios to be simple. If you're working, I don't want to have a portfolio that's buy and hold for 90 days and then start applying all these trading rules to it. We did that. I mean, we got hurt by it in our portfolios. The results would be even better if we didn't get stopped out. There was I think 2 quarters ago, we took a hit on a company, and actually we might've gotten stopped out of 2 different companies, and both of them came back and hurt our portfolios because we didn't just hold them for the 90 days. And in addition to Quidel, which is up on the screen now, this was that big drop, and it's in one of our portfolios. I think it's in the aggressive portfolio, and it's come roaring back. Another one last quarter that would have killed our portfolio, but we held, was ENPH. And this one back in May was sitting at 70, and it went down to 38. It was cut in half in 30 days. And look where it was August 19th. It was a winner by the end of the period. So the whole idea is that you're putting 10 leading stocks in, just figure that you're going to probably get hit on hopefully no more than 1 or 2, and that your big winners. I mean, right now we've got Zoom, which is up 75% this quarter. I'm talking about just since August 19th. If we pull up Zoom's in our model portfolio. Here's where it was. It was 275, something like that on August 19th.
Yep.
It's 482 now. So the idea is that you're going to have some of these that are going to get hit to the downside, but you're also hopefully going to have a couple that are really going to lift your portfolio. Peloton and Neo I think are both in the strong AD, and they're both up about 55% in the last 6 weeks. And so that's how these portfolios have worked. Is there risk? Yeah, I mean, there's risk in any investment. I don't care whether you're following Bill O'Neill, whether you're following Bill Miller back when he had those, was it Legg Mason Value Trust or whatever that crushed the S&P for years. They're picking
until I
stocks.
got into it, then it started sinking. I hated that towards the tail end.
Sorry, I couldn't help but laugh. Everything worked until you get in, right?
It became a greater value portfolio after I got in.
Yeah. It became a better value for the people coming in after you.
Yeah.
Anyhow, my point is no matter what you get in, no matter what's working, you're still investing in stocks. There's always risk. I can't eliminate that. If the way we, and I had a member last quarter who said, you only have 10 stocks in your model portfolio. That's not enough to diversify. Put 40 in there. Your members will love it. And I'm thinking, well, we got 40 stocks in 4 different portfolios. Just buy those 40 if that's what you want to do.
Yeah.
But what happens is the more stocks you put into a portfolio, the more difficult it is to beat the S&P 500. You start moving toward the center.
Yeah.
And that doesn't make any sense to me. So again, we're trying to find leading stocks within leading industry groups, mostly leading industry groups. There are exceptions. We got Chipotle and Wingstop in our portfolios. They're in the restaurant group. Restaurants haven't been on fire, but these stocks have been so strong that we felt they were worthy of inclusion. Plus, if restaurants come back, which I believe they will, I still think consumer discretionary is probably the best area to be in. I think restaurants come back, and I think Wingstop and Chipotle, they've been long-term leaders. I think they'll do well.
Okay, let's go ahead and wrap it up. You know, if we didn't get your question, just go to earningsbeats.com, send it in, and we'll get back to you. Great event, Tom.
Yeah, it was fun. Again, there's so many great things about StockCharts, and UDI is just one of them. So hopefully I gave you some information maybe that you can put to use in your own accounts as you go forward. But well, I'm sure we'll talk about this more, especially with our portfolios. And I'll try to keep everyone posted on that pandemic. As soon as I get that ironed out as far as getting a chart to come up with that data, I'll probably post that maybe in one of the daily market reports this week. So you can look for that. But everybody, thank you so much for coming in. Make sure you go in and check out that webinar special. That'll be up until October 5th. Try our service. If over the next few days you really like it, I would suggest you give us a try for a year. Everybody have a great day. Be back on Monday to do things all over again. And we'll see what's happening with the president at that point too. Happy trading, everybody.